Welcome to Brilliant Bankers, your channel for all IIBF specialization exams. In today's video, we will be discussing about the risk and basic risk management framework. We have already completed a session on risk. Today, we will be totally dealing on the basic risk management framework. And in today's session, we will be going through what is risk management framework, what are the areas where risk management is used in the banking industry, what are the types of risk measures taken in the banking industry, and we will be discussing about the EWRM, that is the enterprise wide risk management. So let's start with the risk management framework. About the risk management framework, to manage risk, a robust risk management framework is very crucial in businesses and the financial institutions. So some of the basic requirements and components of the risk management framework are risk governance and oversight, which is done by the board of directors and the risk management committee, wherein the provide oversight and directions for risk management activities. Risk management committee is a dedicated committee responsible for overseeing the risk management strategies. So management of risk is a major concern for the top management. Successful implementation of the risk management process emanates from the top management, and the main challenge centers on facilitating the implementation of risk and business policies simultaneously in a consistent manner. Management of these risks begins with the identification and the quantification of them. It, it is only after risks are identified and measured that we may be able to accept the risks, or to accept the risk are reduced or are at the reduced level by undertaking steps to mitigate the risk, either fully or partially. The risk management happens to be a job that requires special skill and has an objective which is more oriented towards the control aspect of the business. It requires a separate setup in the organization for carrying out all these things. So, we will be discussing everything about the organization for the risk management, the risk identification process, the risk measurement process, how is risk pricing done, what is risk monitoring and control, and the risk mitigation as well. To be brief, the organization is a board of directors and the risk management committee, which will be looking after the risk management in any organization. About risk identification, it is a process of identifying the potential risks that could impact the organization. This can include both the internal and the external risk. Risk measurement. This involves the quantifying and assessing the magnitude of the identified risk. This can be done by three ways, that is, by sensitivity analysis, the volatility analysis, and the downward potential analysis. And these are done in these three ways in the banks in India. What is risk pricing? It is determining the appropriate price or the premium for taking on any certain risk, especially in the financial sectors and the insurance sectors. And what is this risk monitoring and control? It's implementing strategies and measures to reduce or mitigate the impact of identified risk, which can include the diversification, hedging, or the insurance. Risk mitigation can be done with the compliance of the regulatory requirements and by identification of all different type of risk. Next, we will be looking after the organization for risk management in detail. The organization. In a financial institution, each committee plays a crucial role in managing specific aspects of the risks, wherein the overview of the responsibilities of the board of directors, the ALCO, the Asset Liability Committee, CRMC, the Credit Management Risk Committee, and the Operational Risk Management Committee, ORMC, are in the context of the risk management. The risk management support groups takes over the later part. So coming to what are the duties and responsibilities of the board of directors? Board of directors. They responsibly start the setting risk appetite. The board is responsible for establishing the risk appetite and tolerance level for the institution. This involves determining the amount and type of risk the organization is willing to accept to achieve its objectives. The oversight and the governance is also looked after or taken care by the board of directors. The board provides oversight on of the overall risk management framework. This includes the reviewing and approving risk management policies, strategies, and major risk decisions. Approving the risk policies, the board is the main group which approves the risk management policies that guide the institution's approach to various types of risk, ensuring the alignment with regulatory requirements and organization goals. They also regularly monitor the effectiveness of the risk management framework and receive reports from different committees to stay informed about the institution's risk, ensuring that the risk management practices align with the institution's strategic goals and activities. So, to be precise, the board of directors mainly look after the risk appetite. They govern by giving new framework and policies, by approving their policies, by monitoring and reporting and getting the reports about these policies, and also aligning the risk management with the strategy that has been planned. What is an ALCO or the Asset Liability Committee? What is the responsibility of an ALCO? ALCO is primarily concerned with managing interest rate risk. This involves ensuring that the institutes or the institution's assets and liabilities are appropriately matched to minimize exposure to interest rate fluctuations. ALCO is responsible for ensuring that the institution maintains sufficient liquidity to meet its obligation, especially during the stressful market conditions. It also oversees the management of the balance sheet, making decisions about the asset and liability composition to optimize risk and the return. It regularly monitors the market conditions and the economic indicators that could impact the institution's asset and the liability positions. To, to be in brief, the ALCO mainly monitors the market conditions, ensures the interest rate risk management, looks after the liquidity management of the institution, and they also manage the balance sheet to know what is the difference between the asset and the liability of the institution. The Credit Risk Management Committee or the CMRC develops and reviews credit policies and procedures to ensure that the institution's credit limit is within the acceptable limits. By reviewing and approving credit limits for individual borrowers or group of borrowers, ensuring that exposures are in line with the institution's risk appetite. They also monitor the portfolio management by monitoring the composition of the credit portfolio and taking actions to diversify risk and mitigate the concentration risk. What is a concentration risk? That is investing the whole amount in a single place. And they also do a regular credit quality check, that is regularly assessing the quality of the credit portfolio and identifying the potential weaknesses and implementing strategies to address the credit related issues. They also ensure that the credit risk management practices comply with regulatory requirements of the institution. So, to be in brief, what are they doing? They go through the credit policies and procedures. They go for approval of credit limits. They manage the portfolio. They review the credit quality of their customers and also the compliance with regulations as policies are made by the ALCO. What is an operational risk management committee? They identify the operational risk. Identifying and accessing the operational risk associated with the institution's processes, systems, people, and external factors are their main role. They also develop and implement controls and procedures to mitigate operational risk, including the business continuity plan and the disaster recovery. They regularly monitor operational risk events and incidents and reporting the same to relevant stakeholders. They also ensure that operational risk management practices comply with the regulatory requirements and the internal policies. The, they also develop plans and procedures for responding to and resolving the operational incidents and disruptions. All these committees work together to ensure a comprehensive approach to the risk management, covering a different aspect such as financial risk, credit risk, operational risk. So clear communication coordination among these communities are essential for an effective overall risk management strategy within a financial institution. Other than this, the risk management support group or the risk management support department. This department is headed by the chief risk officer or the CRO, who is normally of the rank of a GM in a public service bank, public sector bank. He will be competent or he should be competent enough and qualified or a skilled staff. And he also will be complemented with skilled staff to manage the following departments, which are the asset or liability group to look into the market risk, the mid office group to look into the treasury operations, the credit risk group to monitor the credit risk, and the operational risk group to monitor the operational and the residual risk. So, what is risk identification and how do we identify the risk? So, risk identification. Nearly all transactions or all type of transactions undertaken will have one or more of the major risk. That is like the liquidity risk, the interest rate risk, the market risk, the credit risk, and the operational risk, with their manifestations in different dimensions. Although all these risks are contracted at the transaction level, certain risks are subject to or are like the liquidity risk and the interest rate risk are managed at the aggregate portfolio level also. Risks like the credit risk, operational risk, and the market risk arising from the individual transactions are taken cognizance of at the transactional level as well as at the portfolio level. Aggregate risk determines the capital needs, the performance of the bank at the aggregate level in terms of the risk adjusted return or the RAROC that is generates in the key corporate issues. Products approved at the corporate level with due screening procedures and appropriate safeguards and a limit on exposure, product wise as also amount wise, provide for necessary guidelines in the risk taking. The guidelines help in standardizing risk content in business undertaken at the transaction level. Any new product or any deviation from the directed procedures and safeguards adds to the risk content of the exposure and needs a clearance at the corporate level, where risk return characteristics and risk quantification forms the basis of decision making. So, what are the types of risk that we are going to identify, and how are you going to explain them, or how are we going to understand them? So, the different type of risks are the time risk, the risk or the basis risk, the gap or the mismatch risk, reinvestment risk, embedded option risk, the credit risk, and the operational risk. Let's go through each of them one by one. So, what is a time risk? Time risk is also known as a maturity risk. Is associated with the potential for changes in market conditions over time. This risk is particularly relevant to fixed income securities, such as bonds, where the interest rates and the market conditions can fluctuate during the life of the investment. For example, if interest rates rise after the investor purchases a fixed rate bond, the market value of the bond automatically decreases. What is the basis risk? It arises when there is a mismatch between the interest rates and the price of two related financial instruments. This can occur when the rates or prices of the instruments are supposed to move in tandem but diverge from each other. An example can be a bank may issue loans with the variable interest rates linked to the benchmark rate, but its funding cost may be tied to a different benchmark. If these benchmarks move differently, the basics risk arises. Gap or the mismatch risk refers to the gap or the mismatch risk refers to the potential for losses due to imbalance or gaps in the maturity or repricing of assets and liabilities. It occurs when the interest rate sensitivity of assets and liabilities is not aligned. If you're taking an example, if a bank has more liabilities repricing the short term than that of the assets, and the interest rates rises, the cost of liabilities may increase more quickly than that of the income from the asset. So, what is a reinvestment risk? It is a risk that future cash flows from an investment will have to be reinvested at lower interest rates than the original investment. If an investor holds a bond paying a high coupon rate and the interest rate declines, the investor may face reinvestment risk when the bond matures and when interest payments are already received. An embedded option risk is associated with a financial instrument that has embedded options, such as the call or the put options, which automatically has a call or a put option in the instrument itself. These options can affect the value and cash flow of the instrument. These mortgage-backed securities may have embedded prepayment options. If interest rate falls, homeowners are more likely to refinance, leading to early prepayments and affecting the cash flows of the security. What is a credit risk? Credit risk, also known as the default risk, is the risk that a borrower or a issuer will fail to meet their financial obligations, resulting in a loss to the lender or the investor. If in case an individual or a company fails to make scheduled loan payments, or if a bond issuer defaults on interest of principal payments, it represents the credit risk for the lender or the bond holder. And finally, what is an operational risk? It is a risk that or risk of losing resulting loss resulting from inadequate or failed internal processes, systems, people, or the external events. So operational risk can be from anywhere. It can be through the internal process, it can be through the system, it can be from the people or any external events. The people can be internal or external. It encompasses a wide range of risks related to day-to-day operations. So understanding and managing these various risks is crucial for financial institutions and investors to make the informed decisions and protect their financial well-being. Each type of risk requires specific strategies and measures to mitigate its potential impact. So, how is that we measure a risk? What is risk measurement? Risk measurement is a process of quantifying and assessing the potential impact and likelihood of various risks that an individual or an organization or investment may face. It is a critical component of the risk management, providing valuable information for decision making, strategic planning, and the implementation of risk mitigation strategies. The goal of risk measurement is to provide a quantitative basis for understanding, comparing, and managing different types of risk. Risk measurement in financial institutions involves assessing various types of or various aspects of potential losses or volatilities. Different methods can be used to measure risk. Risk measurement in financial institution involves assessing various aspects of potential losses or volatility. The different type of measurement of risk are based on sensitivity, volatility, or based on the downside potential. So, what is a sensitivity analysis? How is it based on the sensitivity? Sensitivity analysis, also known as the scenario analysis. This involves assessing how changes in one or more variables affect the overall risk profile. It can be applied on the financial institutions, as financial institutions use sensitivity analysis to understand the impact of the changes in the interest rates, exchange rates, commodity prices, and other relevant factors on their portfolio. By analyzing different scenarios, they can gauge the sensitivity of their assets and liabilities to various market conditions. How is it based on volatility? Volatility refers to the degree of variation of a trading price series over the time. Volatility analysis assesses the extent of price fluctuations for a particular security or a market. The financial institutions use these volatility measures to estimate the potential for large price swings. Standard deviations or the coefficients are the common metrics that are used for the volatility analysis. Institutions often incorporate volatility into the risk models to anticipate and manage market risk. Higher the volatility, if the high volatility implies a higher risk, and the risk managers may adjust their strategies according to their volatility. What is it? How is it based on the downside potential? Downside potential analysis focuses on the potential for losses rather than the overall volatility. It emphasizes understanding and quantifying the downside risk of an investment or portfolio. Financial institutions aim to measure the extent of potential losses in adverse market conditions. The VAR, value at risk, is a common metric used for the downside potential analysis. The stress testing is another method that involves simulating the extreme scenarios by understanding downside potential. Institutions or the institutes can better perform or prepare for adverse market movements and implement risk mitigation strategies. So, in summary, to summarize the sensitivity, volatility, and the downside potential, the sensitivity based risk measurement evaluates how changes in one variable impact another, often used in the context of the derivatives and the option trading. The volatility based risk measurement examines the degree of price fluctuations. The volatility based risk measurement examines the degree of price fluctuations in a security or market, providing insights into the overall uncertainty and risk. The downside potential based risk measurement focuses on accessing or assessing the potential for losses, particularly the negative moments or adverse outcomes, provided a more conservative view on risk. These methods are often used together to form a comprehensive understanding of risk. For example, an investor might assess the sensitivity of a portfolio to changes in the interest rates, considering the historical volatility of the portfolio, and then analyze the downside potential to get a holistic view of the risk associated with that investment, mainly used for the trading of shares. Risk in banking transactions impact in two ways. Firstly, banks may have to maintain necessary capital, at least as per the regulatory requirements, as instructed by the RBI. The capital required is not without the cost. The cost of capital arises from the need to pay investors in the bank's equity in the form of dividends and for the internal generation of capital necessary for the business growth. Secondly, there is a probability. Secondly, there is a probability of loss associated with all risk. This also needs to be factored into the pricing. To explain this, let's take the example of a bank that has 100 credit accounts, which a level 2 risk according to some measure. So the historical observations indicate that there is an average loss of 2% on the level 2 accounts. This loss is the cost associated with such kind of risk. This is to be factored into the pricing. The intention is to defray the possible losses across similar transactions. In this case, the risk premium of 2% may be added in the pricing of the loan itself. So risk pricing implies the factoring risk into pricing through capital charge and loss probabilities. This could be in the addition of the actual cost incurred in the transaction. The actual costs that are incurred will be included in the cost of funds that has gone into the transaction. The cost incurred in doing the services which are incurred by the way of maintaining the infrastructure, employees and other relevant expenses also. So pricing therefore should be taken into account the following things. Whenever we are going for pricing, the following things are also to be taken into account. That is the cost of deployable funds, the operating expenses, the loss probabilities, the capital charge, and the profit margin or return on the net worth or the invested amount. It should also be mentioned that the cost of funds should correspond to the term for which it is being deployed. This is because for a 5-year fund, there may have a different cost than a 1-year fund due to the time value of the money. It is also to be noted that the price is transaction based or the pricing is transaction based. This is one of the key reasons for risk management or risk measurement at the transaction level. RBI also came out with its BPLR scheme in the year 2003. Since it fell short of its original objective in bringing the transparency to the lending rates, RBI again launched the base rate mechanism scheme from the 1st of July 2010 for the same purpose, for the purpose of risk pricing. And it mandated the banks to migrate to MCLR, the marginal cost of funds based lending mechanism from the 1st April of 2016. It has also instructed that all new floating rate retail loans and floating rate loans to the MSME extended by the banks from 1st of April 2020 should be linked to the external benchmark developed by the Financial Benchmark of India Private Limited, the wholly owned subsidiary of the RBI or its own repo rate. So the risk pricing has been taken into control, is being taken into control by the RBI itself, so that all the prices and charges will be based on the MCLR. What is the risk monitoring and control? They are the key drivers in managing a business by seeking enhancement in the risk adjusted return on capital. It is an organization structure that it is an organization structure which has a comprehensive risk measurement approach. The approach to risk management centers on facilitating implementation of risk and business policies simultaneously in a consistent manner. Modern practices consist of setting risk limits based on economic measures of risk while ensuring a best risk adjusted return, keeping in view the capital that has been invested in the business. To achieve all these objectives, so banks has to keep up some main points. That is an organization structure, a comprehensive risk measurement approach, a risk management policies should be adopted to the corporate level as well as the branch level, which are consistent with the broader business strategies, capital strength, management expertise, and the risk appetite of the bank. Guidelines and all other parameters used to govern risk taking, including the detailed structure of the potential limits or the discretionary limits and the risk taking functions, are to be mentioned. Therefore, the approach to risk management cannot be in isolation or in standalone mode. The approach to risk management centers on facilitating implementation of risk and business policies simultaneously in a consistent manner. Modern best practices consist of setting risk limits based on the economy, measures of risk while ensuring the best risk adjusted return, keeping in view the capital that has been invested in the business. So automatically it is a question of taking a balanced view on the risk and the returns, and that too within the constraints of the available capital. So it is not enough to just put in place a structure for the purpose. It is also equally important to ensure that the organization function in a manner it has been planned. Feedback of the actual functioning is therefore necessary for the purpose of the control. The bank's internal control structure is essential to the process. Effective control of the process includes an independent review and, where appropriate, the involvement of internal and external audits are also taken care of. The board should regularly verify whether its system of the internal control is adequate to ensure well ordered and prudent conduct of the business. This is normally carried out through a separate board committee on the risk management. So, what is risk mitigation? Coming to the topic risk mitigation. Since risk arises from uncertainties associated with the risk elements, risk reduction is achieved by adopting strategies that eliminate or reduce the uncertainties associated with the risk elements, which is called the risk mitigation. In other words, the upside potential of the profits would get reduced. In fact, this is one of the most critical aspects of the risk mitigation measures. While risk mitigation strategies help in reducing adverse impact of the business, it limits upside potential as well. That is, chances of getting super profit would also be limited. Nevertheless, one achieves stability in his net cash flow. This is how we mitigate the risk. So, risk mitigation measure aim to reduce downward variability in net cash flow, but these measures also reduce the upside potential simultaneously in all ways. Risk mitigation measures reduce the variability in net cash flow also. It would involve counterparty and it will always be associated with the counterparty risk. It may also be stated that the markets may respond to the counterparty risk by establishing the exchanges such as stock exchange, the commodity exchange, the futures, and the option exchange. In the case of India, for interbank settlements, this is achieved through the establishment of Clearing Corporation of India Limited, the CCIL, which is a central counterparty which was set up in April 2001 to provide clearing and settlement for transaction in the government securities, foreign exchange, and the money markets in the country. So, what is an EWRM? It is an enterprise wide risk management. Achievement of the business and financial objectives is of paramount importance for a bank or a financial service organization. Enterprise wide risk management provides answers to questions like what sorts of roadblocks can the organization face on the way to the achievement of their business goals? So, what are the risk factors faced by the organization? To what extent can the risk factors impact the achievement of the business objectives? How are these risk factors to be mitigated? So, enterprise wide risk management, the risk management process that is being conducted in an enterprise. In that process, we ask all these questions. What are the sort of roadblocks? What are the risk factors faced? How can all these impact the achievement? And how regularly control and monitoring the risk factors are being done? So, EWRM. can be defined as a continuous and structured process of listing the objectives of the organization, identifying all external and internal risk factors that could impact the achievements of the objectives and the organization's business and the financial targets, thereby prioritizing the risk factors, exploring alternatives for the mitigation of the risk, and controlling and monitoring all such risks. So the EWRM encompasses the entire gamut of the operations or the organization's operations and is not limited to a single event or a circumstances impacting the organization's function. It is a dynamic process involving people at all levels, and it covers every aspect of the organization, resources, and operations, and takes a holistic picture of the entire organization for the purpose of risk management. So, how is the EWRM being implemented in the organization? It is by the evaluation of existing risk management systems, which involves the review of the internal environment with a view to access the risk philosophy and risk culture, by review of the process of setting objectives, by assessment of existing mechanism of identifying risk factors, evaluation of the existing process of assessing risk, assessment of process of responding to identified risk, evaluation of adequacy of existing control processes, assessment of the adequacy of existing management information system, and also by the review of the process of monitoring risk. What is a ERW framework? Sorry, ERM framework. The ERM framework is structured around 8 key components. The enterprise risk management is structured around 8 components, and it helps in identifying and selecting among alternative risk responses, risk avoidance, reduction, transfer, and acceptance. It helps to ensure effective response reporting and compliance with laws and regulations and avoid damage to the entity, reputation, and associated consequences keep at the risk, keep constantly changing and evolving in a global economy. So ERM is a never-ending journey. The enterprise risk management is a never-ending journey. And the 8 key components are the internal environment, objective risk, risk assessment, risk response, control activities, the information and commission, and finally the monitoring. 4 key objectives of business are like the strategic, operations, reporting, and the compliance. So let's finally round up what we had discussed in the earlier slide. So what is risk management framework? A risk management framework provides for facilitating implementation of risk and business policies simultaneously in a consistent manner so that a balanced view on risk and returns and within the constraints of available capital can be taken. It should include the identification and its quantification of the risk as well as the provide for pricing of risk appropriately. So what are the area where risk management is used? It is used in the organization, it's used in risk identification, risk measurement, risk processing, risk monitoring and control, and finally in the risk mitigation. So what are the types of risk measures that can be used? It can be based on the volatility, it can be based on the sensitivity, or it can be based on the downside potential of the trade. And finally, EWRM is a process of identifying internal and external factors that impact the achievements of an objective of an organization and its business and the financial targets. It is a continuous and a dynamic process covering every aspect of the organization for the purpose of the risk management. So, with that, we come to the end of this session. And we have completed the unit risk and basic risk management framework. In our next session, we will be going through the risk in banking business chapter. If you have any questions or comments, please feel free to leave them in the comment section below. Your feedback is valuable to us. Do like, share, and subscribe our channel. If you think there is something good in the channel, do share it to your friends also. Until next time, this is Nishant signing off. Have a great day. Jai Hind.